Is Snowflake a buy or a sell? Let's get started with the model. This is a large cap company, 58 billion market cap. They're trading at 175 a share and they have 330 million shares outstanding. Snowflake is a cloud-based data warehousing service. The reason the company is so popular lately is due to its exceptional scalability and performance. It handles the security and encryption of stored data, incorporated in 2012 based in Bozeman, Montana. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looks really good. It grows from 57 million to almost 800 million. Solid margins. They convert 23% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative and getting worse, from negative 700 million to negative 1.1 billion. I think the main reason is because they give out so much stock-based compensation, which brings down their net income, but that's a non-cash item, so it doesn't affect cash flow. Revenue is a sales for the company, and that looks great, from 1.2 billion to 3.4 billion. Solid growth. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 47 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $39 billion. We divide that by 330 million shares. And we get a calculated stock price of 119. They're trading at 175, so they're trading at a 47% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are over 100 companies in the same industry as Snow, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only 79 million. They're a software company. Debt to equity ratio is a bit high, 0.8. For every dollar of equity, 80 cents of debt. It looks like Aspen Technology is debt-free. They have a 15 billion market cap. They generate 800 million of free cash flow, a little less than the average. They rank 7th in market cap. Salesforce is number 1 by far. All their price multiples are worse than the median. They're trading at 17 times book value. We can't look at their PE because they have negative earnings. Trading at 73 times free cash flow and trading at 17 times revenue. Look at DocuSign. They have the best in 3 of the 4 categories. They seem really undervalued. Revenue 3.4 billion, almost at the average. They're currently trading at 175, 26 below their 52-week high, 64% above their 52-week low. Look at AppLovin trading 800% above its 52-week low. That stock's been on a tear. If you put $10,000 into this company when they started trading, you would not be happy at $7,000 today, a 31% loss. At one point, your $10,000 would have been $16,000, but the stock has struggled since that peak. So to summarize, I have them trading at a 47% premium. I give them a ranking of 7 out of 10. It's a really solid stock. I would definitely buy it short-term and long-term. I do like the company a lot. Ratios are pretty weak, 3 out of 10. Financials are solid. Free cash flow up 1,300% since 2021. Revenue up 180% in the same time period. Let's take a look at their most recent 10Q. Here's their income statement. This is for the 3 months ending 10/31/2024, and this is 2023. Revenue went from 730 million to 940 million. Let's get a breakdown of the revenue. Product revenue 900 million, professional services 42 million. Both are up from last year, but product revenue up a lot more, both dollar-wise and percent-wise. Of the 940 million of revenue, 719 million in the US, South America 26 million, EMEA 147 million, APAC 49 million. Everything is up from last year. Their product revenue went up 29% from last year. Professional services went up 17%. So total revenue up 28%. Their cost of revenue is 321 million. So they have really good gross margins. Gross profit is revenue minus cost of revenue, 621 million. Last year, 505 million. Here's a breakdown of the cost of revenue. For products, it cost them 260 million. For professional services, 57 million. The revenue for professional services is 42 million, so they lose money. In professional services, they had a gross loss of 15 million. In products, they had a gross profit of 636 million. So their gross margins, which is gross profit over revenue, is 66%. 71% from product, negative 37% from professional services. And they have more employees working on professional services, 596. Product is 484. That's why they're losing money. because they have more employees and it's so much less revenue. Let's look at their operating expenses. Sales and marketing, $440 million. R&D, $440 million. G&A, $100 million. So their operating expenses are higher than their gross profit. That's why they have an operating loss, an even bigger loss than last year. I'm going to show you why they have positive cash flow, but an accounting loss. This column is a trailing 9 months. It's February 1st, 2024 through 10/31/2024. Even though they had $2.6 billion of revenue, they had a net loss of $963 million. That's their accounting loss. Let me show you the statement of cash flows. The first section on statement of cash flows is operating activities. It starts with your net loss, that negative $960 million, and then we add back the non-cash items on the income statement. They paid over $1 billion in stock-based compensation, but that's a non-cash item. The company doesn't use any cash to give employees stock. They don't pay for their own stock. It does dilute the shareholders though. So that's why we add it back here, and they have positive operating cash flow of $527 million. Let's finish off the income statement. So for the quarter, they had a net loss of $324 million, and they're adding shares. Last year, 329 million shares outstanding, now 332 million. Let's look at a balance sheet. Current assets, $5 billion. So current ratio, a little below 2. They can cover their current liabilities with their current assets almost 2 times. They have $4 billion of cash and marketable securities. They have almost $1 billion of goodwill, so it looks like they do a good amount of acquisitions. They have $5.3 billion of liabilities. Their biggest liability is convertible notes. This is debt that can be converted to equity if the stock price hits a certain point. This section, they talk more about the convertible notes. They issued $2.3 billion of convertible notes. $1.15 billion of notes mature in 2027, paying no interest. Another $1.15 billion paying 0 interest that mature in 2029. The conversion price is $157.50. So the stock price is above that point, so you're going to see a lot of dilution from these notes. Each set of notes will add 7.3 million shares. They have a ton of deferred revenue, $2 billion in the current section, $300 million in the non-current section. That means they receive cash for their service, and when they do provide the service, they'll book that revenue onto the income statement. This is pretty common for a subscription company to receive cash in advance. Assets minus liabilities equals equity, almost $3 billion of equity. They raised $10 billion from selling their business, and they lost $7 billion from running their business. Let's look at a statement of cash flows. This is for the trailing 9 months. The first section is operating cash flow. We start with the net loss. Then we have to add back the non-cash items on the income statement. The big one is stock-based compensation, over $1 billion. So that's why they have positive cash flow. But that doesn't really help you out. That causes a lot of dilution. It helps you in one way, yet hurts you in another way. In their investing section, they spent only $35 million on PP&E. They have a lot going on in their financing section. They bought back $1.9 billion of common stock. I'm not sure why they did that. They need the cash. They issued $2.3 billion of convertible notes. So they didn't really help the company. They just moved it from one part to another. Let's look at a stock on Simply Wall Street. Its last price, $175, 58 billion market cap, up 4.5% in the past week, down 6% in the past year. The company IPO'd at the end of 2020 at $120 a share. On the first day, it more than doubled. It was up to $245. It hit $390 after a couple months, then got cut in half to $200. Then about 1 year after IPO, it was at its highest point ever, $393. I feel bad if you bought it at that level because it came down from $400 to $110. In 7 months, it dropped about 70 or 80%. That would have been a good time to pick it up because then it ran up to $220. That was in the beginning of 2024. Then it got cut in half again to $110. Now it's getting back up there. It's up about 50% since that bottom a couple months ago. Really volatile stock. Simply Wall Street's valuation is $263. They say the stock is 34% undervalued. 39 analysts priced this stock at $180. Their free cash flow forecast for next year is $900 million, 2026 $1.1 billion, 2027 $1.5 billion. Their revenue was under $100 million in 2019, and look how much it's grown since then. It went from $100 million to $265 million. A year later, $600 million. In 2022, $1.2 billion. And it's almost tripled since then at $3.4 billion. They were debt-free until a few months ago. they added those convertible notes. Now they have $2.3 billion of debt. Equity was really high. It has come down to $2.9 billion, a little bit higher than their debt. And they're all cash. Their cash is higher than their equity. In the past year, there's been a lot of insider selling. There were 3 buys. 2 of them were for a decent size, 76,000 and 31,000. So the number of shares purchased by insiders is higher than the sells because the sells were much smaller. 61% of the companies owned by institutions, 32% by the general public, 4% by insiders, and 1% by private companies. Vanguard is the biggest shareholder, then BlackRock, Morgan Stanley, the Snow Trust. This is a trust started by the founder right here. He also owns 1.5% of the company. BMO, Fidelity, Bailey Gifford. Their employee count went up a lot from 1,900 to 7,800. And the ticker trades on the Wiener Börse, Mexican Bolsa, Deutsche Börse, New York Stock Exchange, Zeta, London Stock Exchange, Borsa Italiana, Buenos Aires, and Sao Paulo Bolsa. So if you want to learn how to build a discounted cash flow model in Excel, click on the video in the top right corner. I also send you a free version.